The money in your bank account is not sitting there in the way you think it is. This is not a metaphor. It's not an exaggeration. If everyone went to their bank tomorrow morning at the same time and tried to withdraw their money, the system would lock up very quickly, because that money does not physically exist. This did not happen by accident. It is not the result of a system flaw. This is the deliberately designed way modern finance works. Over the years, it has become so normalized that almost no one questions it anymore. This structure has a name: fractional reserve banking. And this structure is the main mechanism that fuels growing debt, the loss of purchasing power, and the illusion of prosperity. When you truly understand this system, you realize one thing: money is not the solid reality we assume it to be. It is built on promises about the future that can never fully be kept. To see this clearly, we need to go back to a time before digital money. In medieval Europe, money was gold and silver. If you were wealthy, your wealth was tangible. But carrying gold was dangerous, so people began entrusting their valuables to goldsmiths who had secure vaults. In return, they received a document. This document stated that the gold could be reclaimed. Over time, these documents began to change hands. Instead of carrying gold, people used paper, because everyone believed there was real value behind that paper. This was the critical threshold. The goldsmiths noticed something. Not everyone wanted their gold at the same time. Most of the time, the vaults remained full. And this is where everything changed. They began issuing more documents than the gold they actually held. They wrote receipts for gold that did not exist. They lent these receipts and earned interest. In other words, they generated income from something that wasn't real. As long as no one demanded everything at once, the system appeared to work. But at its core, what was happening was this: creating money out of nothing. This idea did not remain small. It became the foundation of banking. Over time, states adopted this system as well. The Bank of England, founded in 1694, is a clear example. Its purpose was not to protect the public. Its purpose was to keep a debt-ridden state afloat. The state borrowed money that did not exist. It paid interest. That interest was covered by taxes collected from the public. This model is still applied exactly the same way today. The process in America was no different. Banks issued money backed by gold. Then they realized they had issued more money than the gold they held. Sometimes people understood the truth. They rushed to the banks. They demanded their money. The result? Collapse. But each time the system was not abolished. On the contrary, it was strengthened. Central banks were created. The message was clear: reality is not what matters. Confidence must be preserved. Now, let's look at today. When you deposit $100 into a bank, you think that money is waiting there for you. But the bank does not keep that money. In the past, it kept a small portion of it. Today, in the United States, that requirement no longer exists. Since March 2020, banks are required to hold zero reserves against deposits. So, where is the limit? The answer? Capital rules. Global regulations known as Basel rules tell banks this: the more risk you take, the more equity you must show. But here is the critical point. Banks no longer look at deposits when issuing loans. First, they create the loan, then the money comes into existence. When you take out a loan, money does not come out of a vault. New numbers are written into your account. Most of the money we use today is not money printed by the central bank. It is money created by banks born from debt. That's why every crisis is, at its core, a crisis of belief. This system produces three unavoidable outcomes. First, inflation. As the amount of money increases, its value decreases. Second, endless debt. Because of interest, the system never truly closes. Third, the concentration of power in certain hands. Those who create debt win. Those who live on wages fall behind. And perhaps the most disturbing truth is this: this system cannot survive if everyone is debt-free. If debt disappears, money disappears. The system stops. Within this structure, you both keep the machine running and carry the weight of the risk. The conclusion to draw from this is not fear, it is awareness. Money is not wealth. Real value is productive capacity, knowledge, skills, and independence. If you understand this system, you create space for yourself. If you don't, you remain in a game whose rules you did not write. If this narrative opened a different window for you, subscribe. Because history leaves enough clues to understand the present, and I will continue reading those clues together with you.